What is going on, everybody, and welcome to another weekly update. And what I like to do in these videos is provide you guys some upcoming earnings, some upcoming events to get you prepared for the week ahead. So if that sounds like something you're interested in, consider subscribing, as I do provide daily content at Hemi137 on X, as I do provide a pulse of the market each and every day, as it does change each and every day if you are in the market. So check me out there. I also provide additional videos here whenever I see fit on current events. So before we get started, remember to smash the like button for the algos, and let's kick this thing off. So right now, what we got going on right now is a very interesting, as we're starting to see, we're starting to get full bore into earnings mode. And this is the most exciting part of the market, as we get to see essentially real numbers. Now, a lot of the data that you get out there um, is not, has been a lot of pencil whipping going on. And I talk about this each and every time that the data does come out, because it does get essentially revised down from essentially these euphoric numbers that we get almost each and every time. Now, a lot of things you have to understand at the same token is that a lot of these numbers, a lot of this data is very, very lagging on what's actually going on. If you want a true pulse of the market, you can go on any social media platform. You hear about a lot of people essentially struggling extremely bad, just trying to essentially stay on par with just being able to feed themselves, provide shelter, and they are having a difficult time to do that. And then so you take that and you look at a lot of things that I discuss and point out, and it all aligns to the fact that we are in a recession, and we're seeing a lot of things that are pointing to that. In that essentially by the time this lagging data actually catches up with what's going on, the Fed are going to overshoot this extremely bad, and you're going to see a massive drop in employment just all of a sudden hit the market like it came out of nowhere, where in fact we've been seeing this for a while. We're seeing the track record, and again, it's going to hit everything like a ton of bricks, especially when you got Yellen and Fed and essentially the administration telling you that everything is okay, when in fact it is not the case at all. We've seen this scenario play out just the same in 2006, 2007, right before the great financial crisis. Again, not trying to scare people, but I'm trying to get you a realistic perspective on what's currently going on, in that this is not sustainable. The prices are not sustainable. It is unaffordable for everybody out there. And even the 1% out there are holding off on purchasing anything because it is just too unaffordable. The people that are buying things up are essential institutions trying to set up for rental properties in particular, not so much the stock market, but understand where that essentially that demand is coming from as of right now, because people are essentially getting in some interesting ways just to continue to stay afloat. And I'll get into some of that when we start getting to this weekly recap here. So again, there's a lot going on right now, but again, we are trying to give you a perspective of, we've had a lot of big bank earnings, and we've seen trust got absolutely obliterated this past week when it comes to banks. Um, you also have some airlines. Travel has been taking a massive, massive crash. What's currently going on, people can't travel anymore. It's not typically the travel type season, as we've had some very harsh weather over the past couple weeks just across the Midwest and on the East Coast. And so with that being said, people just aren't traveling in general. And then also you have Sports Illustrated. Sports Illustrated, if you grew up in my generation, you were very familiar with Sports Illustrated, and now they have completely laid off everybody. Layoffs are all across the board. So it's not only just tech. Tech was very beefy, especially like you want to talk about the .com bust. It was very beefy, just trying to innovate. So now there's been a lot of fat that's been trimmed. A lot of people, a lot of different conversations. I go across all aspects, try to get a pulse of the market, and looking at all these things, is people are essentially paying more for top talent, and very slow to hire people, and laying off a lot of excess people because they just can't afford it right now. And that's where you can trim the most. And then innovation steps in, where a lot of people are betting on AI and robotics, which I think are still AI can help a lot. AI can trim essentially engineers time in half and help them focus on what they should be focusing on, which helps a lot, but it's not going to take over a lot of jobs yet. And robotics, again, is still quite a few years away before that does happen. I think that's probably about 2 years out before robotics start taking over a lot of the minimum wage jobs. So again, very interesting state that we're currently in and setting up for, especially this year. We got an election year, so there's a lot going on just in general, and we need a correction. We need prices to change so it's affordable. So, with all that being said, it's kind of a delayed start there on my behalf, but let's go ahead and get into the weekly recap. So the S&P 500 hit all-time high for the first time in 2 years. It's been struggling to finally break it, and it finally broke. Now, this is something I've talked about in 2022, and 2022 essentially ended. It's every time I hit all-time high, it would essentially start stinging. Or when 2022 first started, I should say 2021, when we were trying to break out, every time we hit an all-time high, essentially we would wick down uh, for within like an hour of us making that all-time high. And then we had 2022, which was essentially a huge sell-off for tech. This past year, essentially it's been everything has been essentially obliterated, but essentially the big seven and the hype of AI has pushed a lot of tech back to all-time highs. And then now you got some help out of value and some out of banks that have essentially pushed everything back up to all-time highs. And now we finally got SPX 500 back to all-time highs. Again, there's massive manipulation. March is going to be important because now banks are essentially their backstops are running out, and need to actually start having the resources on hand in case there is another bank run. And I've been talking about the bank stuff all the time, so don't be surprised when this stuff happens, right? Like there's tons of bank branches that are being closed. So it's not saying that they're not these banks are going completely bankrupt, but they are closed. The bigger banks are closing branches because they know what's happening. And again, this pool of money this tool, quote unquote, that they created, which is again just a repackaging of, let's put $10 billion in here and 10x leverage it. To essentially cover any kind of losses that these banks are having. And again, if you know anything about banks, you have to understand that they're underwater a ton, but you don't see that because they don't put this on unless it's essentially those books are brought to market. You don't see the massive amount of money that they are underwater. Which is scary to a lot of people if you actually realize what was going on with the banks and how banks actually work, and why it's extremely important if you're going to be in any market to understand how banks work. So with that being said, we got five rate cuts predicted for 2024. Again, this scale is very, very inaccurate. But it drives a lot of the market moves off of what's going on with this scale. You have to understand that last year we were pricing in 4 rate cuts and we got 0. This year, I believe we will get some rate cuts. I believe strongly that we will get some rate cuts during this year. But again, that's going to sway. It was up as high as 7. Now it's down to 5. I think it's even gotten down to 3 at one point. So it fluctuates a lot. But as of right now, we're sitting at 5. What is interesting this week is China's largest brokerage banned short selling. We've been talking about China a lot. You need to pay attention to what's going on with China and Europe because it will also affect us, as they both hold a lot of U.S. bonds in your arm, essentially a debt-based system. And you have to understand that if they get essentially affected, it's going to affect us just as much. And we've been talking about this with Country Garden and their other company for the housing development, that essentially they've delayed payments for a year, which again, they still could not make, and still trying to delay and trying to be able to essentially force bankruptcy so they don't have to pay it because they cannot pay it. And understand they're selling luxury vehicles to make a $600 payment that ultimately was only a fraction of the billions of dollars that they had to pay. So these are things you need to keep in perspective, and don't think that we are untouchable. We are very much untouchable, especially on a debt-based system. So that happened, and what essentially you're getting out of that is that, yes, they don't want people making money off of market crashes, is what that means. But what that does is draw panic into, well, why are they stopping people from shorting the market? Because something big is about ready to happen. And we have to also recall that China is also pumping billions of dollars into the system to try to get demand to come back, right? They're in a massive deflationary state, which is actually way worse than inflation, because now you've killed demand so much, people have no money. They're not going to go out and buy anything. So any money they do get, they're trying to build that nest egg back up. So these are things you need to put in perspective. And Europe is right there. And as we get down here, I have this other line here where London home prices fall at the fastest pace since 2009. Right now, they're starting to get more supply of houses, and something I've talked about the U.S. The U.S. is only going to get to that point once we get more supply. The housing correction will happen. What you've seen over the past 2 years is it's been so unaffordable. People have moved. A list came out this week also of the most places that have massive growth, and you're seeing places like Ohio, Missouri, and Tennessee, a lot of Midwestern states that are super cheap. People are moving to try to save money. If you think we are hitting a soft landing, we are not. People are moving. And this leads to this next one here. This homeowners trade 3% mortgages loans for 6%. People are still trying to come up with ways to not sell their house, which is leading up to the fact that they're going to eventually have to sell their house. But they're taking on new mortgage loans to try to pull out some sort of equity to stay afloat because they can't afford it. So you tell me if inflation is quote unquote defeated, like your administration and Yellen is telling you, because that is not true. So with that being said, the global economy is essentially set for worst half decade of growth in 30 years. Now, I talked about the GDP, and I'll get into this. As you can see on the upcoming events on Thursday, we have the GDP of Q4. Now, this is just the preliminary. There'll be corrections here, I think, in about a week or so, or maybe it's a couple weeks. But we'll get GDP numbers. We have another gauge. I think it's the GDL. It's called the GDL compared to the GDP. And the Fed have actually made comments about this, that the GDL is actually a more accurate version of what the GDP actually gauges. And understand that the GDP and the GDL, there is a wide gap between what the GDP is. With all this fluff that we're getting for the GDP, it's pushing it up, and the GDL is it's beyond recession level numbers. And the only other time it's been there's been such a gap between the GDP and the GDL has been in 2008 in the Great Financial Crisis. That's the only other time it's been there's been such a wide divergence between the two, and we're seeing that now, and it is really bad. I've talked about the M2 money supply as well, right? It's like way negative. Everything, all the numbers that are really meaningful, that are more accurate, because a lot of the stuff that's headline news is all very lagging indicators. Things are leading to a massive, massive recession. And I've talked about rolling recessions. Yes, that helps to an extent, but you have to understand is that this is going to be so overshot that when those real numbers catch up, it's going to be bad. It's going to be like going 60 miles an hour straight into a brick wall is what's going to happen. And then things are really going to go downhill to where the Fed are going to have to cut. So we've talked about March. This is something we've talked about potentially cuts. A lot of things are kind of, I think we got a 60% chance at this point. That keeps fluctuating about when it might actually happen, but we got a 60% chance that we'll start cutting in March. I don't know if they're going to just do it, just try to alleviate some pressure. But the problem is we're starting to see inflation increase on the number side. And yes, we have seen a decline on essentially what is currently going on with inflation to some points, right? You have to understand people are focusing all their money on on just basic necessities. And so anytime there's any kind of influx, you did have the holidays, you're going to see have some sort of inflation pump up because of that. So seasonal adjustments are always in there. But you have to also understand people, we went through, this is why this essentially this earnings is so important, because this is typically one of the biggest spending quarters of the year. And people, we've seen historic numbers already come through on buy now, pay later. We've seen we're hitting new all-time highs on credit card debt, right? And people are concerned that when rate gets cut, that people are going to come flooding in. And the problem is there will be nobody there to take on new debt when prices, essentially these home loans, are starting to come down. People are actually starting to just pay out of pocket, or actually a lot of kids are starting to use their parents to help them pay for houses or anything else outright, as opposed to getting a loan if they can avoid it. And so, and you're seeing this, and we talked about this last week about the uptick in essentially home ownership went from essentially an average age of 35 up to 49. So these are big things you have to understand, and how that's going to play out over the next couple years, because eventually, right, that older generation, they're going to start passing away. And when they pass away, that essentially those houses are inherited, and most kids don't want to live in those houses, so they sell those houses. So those 3% that they had, they're going to go away, and then they're just going to take on the money, because they don't want to either one particularly live in that location anymore, and there's no need for it, right? They create their own lives. And so you can see how this is going to essentially affect later, year, in a couple years down the road, and how this is all going to change. So again, we are in a very bad state. And going back to the GDL, um, again, these are the more accurate indicators that are pointing we are going to hit a very deep recession. There has never been a soft landing, and no, this time is no different. It's always the same. When you get these very accurate indicators, that are the most accurate things out there, they're going to tell you what's actually happening. And again, it's going to hit the market like a ton of bricks. It's 60 miles an hour into a brick wall, and it's not going to be fun. Or if you've known, everybody's been affected about what's currently going on, whether it's directly, indirectly, someone, or you are experiencing some sort of stress because of the current market environments. And so, with that being said, you have to be very, very cautious about moving forward. And now that we're all-time highs, why would you be buying at all-time highs at this point? Even through all my videos, I talked about specific times when you should have been buying. Again, it's not financial advice, but ideal times you should have been buying. And it played out. I talked about the potential run up for the back half of the year, and that's what it did. And then also from this point, I think we will continue to get some sort of push up now that we've broken all-time highs. It's going to be very important how we open up next week. If we continue to push up, or if we wick back down, that is a problem. Again, we can continue to push up because we haven't gotten through major earnings yet. But again, also understand AI has been driving a lot of this hype still. And I do believe it will continue to drive hype, as it will be the future. So will crypto, once we get a recession price in, and that is once we get the first cut. We don't know when that's going to be. I don't believe it's going to be scheduled. It could happen. There's a possibility it could happen, but I think there's a stronger probability that what's going to happen is we're going to get an emergency cut when that happens, and it may be more than one. So again, when we hit that brick wall, that's when the Fed's going to start cutting, but we don't know when. That brick wall, it's like running in the dark as fast as you can, and all of a sudden you hit a brick wall. You don't know when it's going to happen, but it's going to happen at some point. So let's look at the upcoming week here. Again, we got the Q4 GDP. That's going to be important. Again, when it comes to like market events, they're kind of diluted around this time, because it's more important to pay attention to what's going on with earnings, and what they're reporting. And we got a big week of earnings coming up. But the GDP is going to be important, obviously, and to see how we're doing, because even like I talked about, the GDL is way, way lower. I'm talking about huge. It's like in the negative territory. I think it's like -8, to be honest. At this point, it's really, really that bad compared to what the GDP is. And so again, that numbers is very, very lagging in what's actually occurring. Then we got core PCE. Again, all these numbers are pencil whipped. I don't really care about the numbers at this point, but I'm just essentially talking about them because they can have an intraday cause an intraday move. And at this point, we're just waiting for that linchpin to be pulled, but we don't know what that linchpin is. We can't identify what that linchpin is just yet. So you just have to be ready and on your toes. Not saying don't take advantage of the markets. I play intraday. I play swings ultimately. And again, I'm going to emphasize this: none of this financial advice. And this is the dip I've been waiting for to buy. So when this starts to cut, we don't know how low we can go. We can go really low when you price in a recession. That's an average of 42%. I talked about this even in 2022. When we were declining, we saw a huge decline in tech. So it'd be interesting to watch how far tech falls once we do first to get that first cut. But again, what's going to matter is after that first cut, is demand going to come back? Then we're going to really have to start focusing on essentially the core inflation, right? Because we don't want demand flooding in like crazy either. So that's one thing we do have to watch. So that's that for this week. Upcoming monetary policy, we still got another week out for that. So we got blackout period for this week. We've had Fed all this past week. Now it's blackout period, so we won't hear from the Fed until monetary policy next week. Again, not expecting anything there. Core inflation on the February. This is what really matters here is upcoming earnings. Again, these are just the ones I'm watching. We got Netflix, which will be extremely important on Tuesday after hours. You got Tesla, which will be extremely important. They're continuing to see declines. Again, I think Tesla will rebound at some point this year, but I think it's more so probably the latter half of this year. Again, we really have to just watch and see. ASML is important. We also got Lam Research as well, which is not on here, but those are important for chips. We did get chip information over the past week. They did. Taiwan semiconductors did extremely well. So expecting a big earnings from essentially NVIDIA, which we've seen NVIDIA pop. NVIDIA is leading the way again on that. And then Thursday, what's really important here, it's not going to affect the market, but it's good to see on credit card debt. So we do have Visa on Thursday. I think on Friday we have American Express as well. So we want to see essentially what their CEOs are saying. That's important just to capture what they're saying there. And then these are adjustments. Again, when there's no major anything scheduled, you're not going to see anything major happen with SPX here. So the numbers are about average. Again, if there are reporting earnings, it will pop, just like Tesla has reported earnings this week, so it's higher. Boeing has been in a lot of trouble lately. Their planes are falling apart. There was another plane that was on fire coming out of Miami this week. So they're pricing a little bit more than average. And then JPM is sitting at 3. So again, what we're really trying to watch is to see if there's any kind of new headline news coming out. And again, there's a lot of banks, regional banks reporting as well in between a lot of these earnings. And that's how they kind of try to shuffle these in to advance talks and stuff like that. And what you really need to be paying attention to. So again, this is the time to be paying attention to what banks are going under. Again, running in the dark, full speed. There's a brick wall. Can't see anything. At some point, you're going to hit that brick wall, and then that's when everything's going to come crashing down. So, and again, you have to understand when that is priced in. No, it could take a couple months, right? It could take like 2 months in that priced in. So when it starts dipping, when you get that first cut, where you want to just start buying, you don't want to, oh, they got the cut, and they just start buying on the first dip, right? So I'm just trying to say it could. I don't really think it's going to be like a crash, but it's going to expand over a couple months or a couple weeks to price in that in, and I think it will sell off quite heavily during that time. And then at that point, I think we will turn on the money printer, and then we will just we will have one of the biggest boom cycles, I think, in our lifetime when that happens. So just be prepared when it does. Don't get ahead of yourself is what I'm trying to say. So as far as SPX, again, new all-time high. We finally have achieved it. Again, we've talked about how this parabolic move, this is not a healthy bull market. This is we've hit an official pause. So this is hopium. This is pretty much a hopium pump, right? And then 42%. And now that we're making all-time highs, I don't know if we'll make a new low on SPX, but let's just assume open up on Monday and we correct 42%. So 42%, again, 42% is a lot. That's only 26%, and that would pull us down to 35. Again, it's you're looking roughly around 3,200 is what you're looking at. And that's on average. It could be a lot more than that. It could be less than that, but expect a price in of a recession when that cut comes. This is the way every one of them have played out, and especially with the inversion of the bonds, bond yields. Every time that gets inverted, this is always what happens. There is no, oh, well, this is a special case. No, this is always what happens. And the cycles are always the same. They're going to tell you it's not. You can go back in history, and every time you've had a recession, they've all repeated the same thing, soft landing, all the BS that you hear. This is all how it always plays out. So at this point, we are essentially in price discovery. So you really don't know where we're going to go. In my opinion, I would at least look for a pullback to that 4,800, and then maybe a bigger push up. So this week will be important to watch to see how that is. You have to understand right now, too, there's a big change. A lot of Americans believe that there will be no recession. Typically, when you're not expecting it is when it happens. This is how black swan events occur. So it may seem that way, but you have to understand over the past 2 years, people were expecting the recession to hit, and it never actually officially hit. Now, when they actually, quote unquote, say we've had a recession, that is like a year and a half after it's actually happened. So you can't expect them to call that. If they call that, that means it's already occurred. So again, we haven't priced in a recession. So we will wait and see how that does happen. So right now we're price discovery. We'll look for the pullback. That's normal to have a pullback and then a pop. We'll see if that happens. Otherwise, we are currently watching this level roughly around the 4,800, and then our level below that is essentially that 4,600. We have a small support here roughly at that 4,696, 4,700 is kind of what we're watching. So all those essentially the magical round number is typically your supports anyway there. So with that being said, we'll see what happens here. So again, there's no major event this week that is scheduled unless for some reason there's a massive price cut or some big headline news. This won't move much this week. You'll see bigger movements in individual stocks there. So let's take a look at Bitcoin. Bitcoin, since the approval of spot ETF, has been pulling back. It's been holding that 40 level pretty solidly. This is something I've talked about, is that, yes, there's been massive amount of money being dumped into Bitcoin, but you have to understand this is what goes on. When I talked about when this approval was going to happen, it's not going to just automatically just shoot up. Even when you look at the gold ETF spot approval when it happened back in 2008 or 2002, excuse me, it took years, but there was a massive like 400 or 500% push up over a span of like probably, I think it was like 8 years. You had a massive push. That's what I'm talking about. That's why I'm saying on this dip you want to be buying, because once this recession is priced in, you're going to have a massive push up in crypto, a massive push up. It's going to all be led by AI and crypto. And then you're going to have this massive push up. And so these are things that I'm talking about that you have to pay attention. And so even though it's pulling back and you're like, well, Marcus, that's not what it is. And right, that's not the case, right? The case is what I'm telling you is that there is a pullback. This is a normal pullback. We've essentially gone parabolic. It's going to pull back and then it will start pushing up. Okay, so just be prepared and be buying on these dips is what I'm trying to say, and expect it to potentially go down to 25,000 and then keep buying that dip, because at some point it will recover and it's going to go parabolic. Bitcoin will go parabolic, AI parabolic, everything in general. At the time that's when the hopium comes back. But again, it's not going to be again straight vertical, because at that point you get into that point to where you've killed demand so much, you don't know how quick that recovery is going to be. But again, I think it will be led by crypto and AI, in my opinion, to be able to pull us out of the hole that we're digging as of right now. So that's what we currently got there. Let's take a quick look at bonds here. Bonds are still pulling back. Like I said, bonds could probably still come way down to that 90 mark. I'd still make a higher low. Kind of had I think that was officially the bottom, was in October. So I think this is just going to be a higher low for the bonds. And again, once we start getting that cut, this is going to start running up. So just be mindful of that. So people are anticipating that. I think we got around that February, March. That's why I'm thinking like March is a good period for that, because that kind of puts us closer down to here. By this next month, I think we can like kind of pull back further down here towards the back half of February, then start potentially start rocketing up. So again, these events, they kind of correlate with everything that's kind of going on, and you notice that the longer you're in markets, that kind of does that. So that's what we're watching there. Tesla, again, Tesla's been in a lot of bad news. The cars are freezing and everything, especially with all the cold front that's been moving in. So it's been had a lot of bad news coming into here. So this 200 level is a good level to be buying, but expect this thing to potentially hit 150, maybe lower. Like I've always talked about when I talk about these, especially tech, if there's any kind of rise in inflation or anything like that, and you start getting cuts, right? Like the pricing for these, we don't know. Do we see a bottom back in 2022 for tech? A lot of big things took some major hits in tech. So we will look and we will watch. So again, this is one of the ones I really do like, and not so much because of the car portion of it, but you have to also understand that I like Tesla because of Optimus in AI. And Elon talked about this past week about potentially breaking off AI from Tesla, and I think that could be a problem for Tesla. Is I think future investment, you want them to keep AI associated with the company, and he wants 25% ownership. It's understandable because he doesn't want it to become something that is profit driven, and that can essentially put the human race at risk, right? When you're talking about AI and how AI can easily manipulate the human mind. And so anyway, very interesting watch here. And so when it comes to essentially robotics and AI with Tesla, I think that's the future of Tesla. I think with automobile, I think that's pretty much, and it will get better and continue to put out regular numbers, especially with Cybertruck and stuff like that when Cybertruck gets better. But ultimately, again, understand where they're going to be really profitable is when they start hitting that AI, because that's essentially the next train. Is not just EVs anymore, but it's the AI and robotics. So that's what I'm really heavily looking at Tesla for, and I think can switch hands at that point. So we'll see what happens there. So I do like the 200 level. And then again, like I said, I like the 150. But again, if you're going to hold anything, understand that there's going to be volatility, but you have to be ready for it because you do not want to miss this pump is what I'm trying to tell you. So again, none of this financial advice, and slowly ease your way into these positions. You should have that list like I've talked about. I have a list here of ones that I'm really watching on this dip. So watching Tesla closely here. Again, they have earnings. They've been selling off. We'll see how well they do on earnings. Again, they've hit well, and this is the biggest thing to watch this week is to see what Elon says. I'll probably do a video on that as well to kind of see what he says and kind of dissect that because that's important. He's got a great pulse on what's really going on as opposed to everybody else that has an opinion. I think he's a frontliner. He runs multiple companies, so he really knows when it comes to inflation. He really knows about what is currently going on in the current environment, and he didn't sound very happy about the current state of the market when he talked on that last call. So Wednesday will be important. So we'll see how that does go. And then let's look at Palantir here. This has actually been holding extremely well. It's been holding essentially this $16 mark extremely well. If we do price in a recession, I can see this coming down. Will we see single digits Palantir? I don't know. They've even tried to downgrade Palantir before earnings, and it hasn't really dropped all that much. So again, I don't really know how low this can get. Any of these levels, I'm buying, slowly buying this one. Again, I think it will, especially with the wartime fear coming up into maybe not this year, but I think 2025 is going to be important. So I think any kind of like wartime AI stocks are going to be extremely important. So that's why I do like this one going into 2025. Again, yes, this year is the year of accumulation. But essentially between now and I think July is the year of accumulation. And then 2025, maybe the back half of this year, 2025, are going to be your explosive years. Once we get that price into that cut, that recession, those will be your explosive years in the stock market. That's in the stock market. Separate that from automobiles, separate that from housing. All those are going to be continue to be affected moving forward. That's something you have to understand. So as it will take a long time, right? And I've talked about this scenario on how these phases play out, that once you kill demand, you have to get it back, and we don't know how long that could take, right? And it may take a very long time, because if you're essentially removing people from their homes and essentially taking away all that money that they had saved, which is pretty much where everybody's at. So people are trying to refinance and everything, just trying to get extra cash at this point. And the market doesn't recover quite as well at that point. 2025, I think, like I said, the market adjusts quickly to things like that, but the rest of the market does not. So just, again, keep that in mind. And then let's take a look at, I want to take a look at NVIDIA here. Now, NVIDIA is absolutely parabolic. Obviously, it's the whole infrastructure for a lot of the AI. It's continuing to make new highs. Again, the semiconductors did absolutely well. They killed it on last earnings and actually pulled back. So again, this is an earnings run up. You still got some time. It's saying towards the back half of February, which is funny. I mean, this isn't in stone yet. This is why it's got this. This is kind of more. Oh no, it is actually on the 21st. So okay, on the 21st, so we got a while. So they've essentially pushed this out all the way to the 21st to try to keep their market afloat as long as possible till March. Again, strategic planning. Amazon, I think, is on the 6th of February, and you have NVIDIA on. So you get the pulse of where the consumer is at on the, I think it was, I believe, the 6th of February. And then you got the hype of AI on the back half, almost on the back half of earnings, right? Because you only got another month before the next cycle comes on. So again, very interesting to watch. I think this thing could potentially even hit 700. So looking for a pull. We'll see how the market general sentiment is here coming into this week. See if there's a pullback to 557. But this thing is going to rip and continue to rip, especially with you getting good. You get Intel this week, I believe, as well. So you're getting a lot of chip manufacturers that are doing very well. So that should lead to NVIDIA doing extremely well, as they've essentially led the cause on this. So again, earnings run-ups are very important. NVIDIA is going to be one of them. I want to keep a lot of chips. AMD, Qualcomm are also ones I want to be watching moving forward as well. And then let's take a quick look at PayPal. PayPal said they announced this week that there's essentially going to be a big report on the 29th, I believe, which is this week, on what they are repping. So I've been talking about this one for a while, about a good buying one to buy, because it's been essentially cratered for such a long time, and they've had patents on AI. And I wouldn't be surprised if they came out. They have a new CEO. This is why I like PayPal more now. Before I could care less about PayPal because they weren't really doing anything, but now that they get a new CEO, now they're revamping everything. They're focusing only on 5 things. They're not scatterbrained everywhere. In the fact that, again, they had this big announcement and they put a patent in on AI, which is really exciting to see. And this thing could go extremely parabolic. So keep a tight watch on this one. Again, key levels here. I wouldn't be surprised if we get a pullback to the 58. But again, watch. If they start announcing AI, this thing could rip to 100 very, very quickly. So intraday play might be really good as well, if especially starts getting hyped this week on whatever that announcement is. BA, again, a lot of bad airplane. I'm surprised it's only this far. Looking for a retest here at the 220, but trying to see if we can get a new low here or retest this 176. Again, depending on the time frame of this, if we get a cut, this thing could even make a new low. Again, it always boggles my mind that it has horrible earnings and then it has these moves right after the fact. So again, it's backed by the government, so it really doesn't matter. But I can see this still selling off more is what I'm trying to say here. So look for that rejection off the 220 and see where we go from there. Let's take a look at banks. JPM over the past week, it had massive sell-off, despite the crazy earnings that they're not posting all their losses. It's just crazy how the banks works. But anyway, Let's see if this can break back to new all highs. I'm actually anticipating this to come back down, so I'm kind of watching that 160 level. See if we come back and do a retest there. Potentially start selling back off to these lower levels like the 140 and 130. Again, I'm still bearish. I'm not going to change that. My sentiment in general is that we are very bearish until we price in a recession. Once that's priced in, once those lagging numbers catch up and we hit that wall and price in a recession, then I will flip to bullish at that point. I've been bearish for what 3 years. I think it's the longest time I've ever been bearish. But now I'm still have that bearish sentiment until we price that in, and then again, like I said, the market we could recover after that, but again, the rest of everything will take a while to recover. So, if you made it this far, I do appreciate you. I know I'm rambling quite a bit. There's a lot of information, especially around this time. There's a lot to talk about, and I know on other videos when we don't have earnings, we don't really have a lot to talk about. We're just waiting on scheduled events. So again, it's very exciting on what's about ready to happen. Even despite the current market, I hope everybody's well and taking care of themselves, and I hope everybody's accumulating as much money as possible to be able to take advantage of what's going on right now and what will happen, especially not only of the stock market but of the automobiles, which are also doing extremely bad right now. It's a good time, again, not financial advice, to maybe purchase a vehicle. January is always one of the best times to purchase a vehicle in between before people get their tax credits. And then with the only problem with that being is that, again, supply was really affected during the pandemic. So I don't know how much more we're really going to drop in automobiles, but I can say in the housing, we haven't seen that played out yet. And I think that is still something that we're going to see over the next couple of years that is really going to take effect. So again, with all that being said, I appreciate you. Go ahead and drop a thumbs up if you made it this far, and I will see you guys on the next one.